Really glad to have you in today with us. My name is Miles Grade. I'm the Director of Sales and Acquisitions at Boardwalk Wealth. I'm joined today by our principal at Boardwalk Wealth, Omar Khan. So here's what prompted the webinar we have for you today. I want to cut to the chase. I know we're in the middle of the day on Wednesday. We had an investor reach out recently and say something that perked my interest. They said, my goal is to learn as much as possible about risks, not just benefits of multifamily deals. And frankly, I love that because most of the content you see in this space today is all upside all the time. Passive income, tax benefits, generational wealth. And look, those things are real, but they're not the whole picture. And if someone is only telling you about the sunshine, they're not preparing you for the storm. So today we're going to go deeper than the usual disclaimers. You probably heard this is a liquid. Um, or you could lose your entire investment. That's true, but it's also not very helpful. It's like a doctor telling you surgery has risks without telling you which risks and what the odds are. I think that resonates with some of you more than others. We're going to give you the specifics today, the stuff sponsors don't usually say out loud, not because we want to scare you, but because we think informed investors truly make better partners and better partners build better deals. One thing I want to say up front is if you're investing in a syndication, you should be comfortable with your capital being in play for honestly 5+ years minimum. We typically project 3 to 5 year holds, but the reality is market conditions can extend that. And we'll talk about why that's not always a bad thing. With all that said, again, we're wanting to open the kimono today, be fully transparent with y'all. I want to hand it over to Omar to walk us through some of the threats to investor capital that aren't always obvious.
Well, thank you, Miles, and thank you for not sharing your screen pretty early on in the game. So I appreciate it. Look, I mean, I've got my notes here. We come prepared, so I'm going to be referring them. But look, the biggest risk is always picking the wrong sponsor. But that's a bit like saying, the biggest risk in flying is crashing. Kind of like a no shit comment, but it's not really actionable, right? So let's talk about some specifics. I've got my notes here. And number one, I think it starts off with being transparency. Look, is this sponsor transparent? Are they providing easy to understand ways? Okay, here's where we take your money. Here's the fee structure. Here's what happens. And here's our range of outcomes. Because if any sponsor can tell you to the second decimal point what the IRR is going to be in, like, I don't know, 5 years, 3 years, 10 years, they're either a magician or a liar. And we know magicians, they don't really exist outside of Las Vegas. So, number one, transparency is very important. And it's not just on big items, but it's on small items. Like lately, for instance, I've been hearing a lot of folks have capital calls and a lot of investors understandably getting upset. Now, we've never had a capital call. And it turns out that in some of these sponsors' documents, the capital calls are not voluntary, as an example. Like investors are forced to participate, otherwise they realize there are punitive measures that are attached to this. And they did not know this going in. So it's not just telling you about the upside, oh, you're going to make all this money, this is what's going to happen. It's also transparently and clearly telling you, okay, here are the risks associated with doing this action. There is no action that are only pros and no cons. So clear transparency is number one. Then there are some specific, for instance, deal or mechanical related issues like interest rate sensitivity. Now, as many people have found out the hard way, real estate is an interest rate sensitive investment. This is a fancy way of saying that when interest rates move up, which is what's happened in the last few years, the value of real estate typically goes down. And when interest rates move down, which happened for a significant portion of the last decade, values go up. People make it sound very complicated. Obviously, there's operational elements and other macroeconomic elements, but interest rates do play a huge part. And to not clearly, accurately define that, not share it with the investors, that I think is frankly malfeasance. Look, to give you some context, we always present or try to present to our investors framework. Look, here is the investment we have. Here is why, in certain cases, we put fixed rate financing on, right? That's usually what we've done. Why have we done that? Because, as an example, there's a thought process now with so many people being burnt. Now, predominantly, we are fixed rate financing people, but there's this thought process that you should always either do floating, always do fixed, or some or the other. And I don't think necessarily that's the right way to go about it. The reason why that's not the right way to go about it is because you have to match your debt, which is basically the interest rate structure you're going to put on and the loan terms and all of this, with the type of project you have. As an example, if you want to hold long term, you've got a stabilized project. You should put long term fixed rate financing on it. But if you're acquiring something highly distressed, it's opportunistic, requires a lot of stuff. Well, frankly, putting long term debt on it doesn't make any sense. So, in that regard, you might have to get bridge debt financing. My point is that you should marry the interest rate and loan structures with the type of um, investment or business plan you have. And oftentimes people confuse these two things. They don't adequately declare it, these sponsors, and they might not even know it themselves. And that's what causes a lot of problems. Now, the other thing, for instance, to look at now, okay, you've got a great sponsor, good rate, and financing structure put into place. What are sub-market risks? Sub-markets are like specific to where the asset is. What are risks? As some people have found out the hard way in New York in the last couple of years, in California, in Canada, where I live, especially Toronto, that if you have laws that do not favor the landlord at all, in fact, if you're the landlord, you might as well be the Antichrist. That's how punitive these land laws are. Then you are going to get into situations where basically you might not see your money back.
Hmm.
Right. So understanding what are the sub-market dynamics to give you some context, something that hits closer to home and how fast things can change. DeKalb County in Georgia, as an example. Now, Georgia is considered a state that has some reasonably balanced landlord and resident laws. DeKalb County, for the longest time in the last few years, you could not evict any residents. Because you could not evict any residents, what started happening is people stopped paying rent. Now, when people stopped paying rent, it wasn't like, oh, I got one up over my landlord, because now here's the problem in the county. The problem in the county is lenders have lost money, sponsors have lost money, investors have lost money. So new investment is happening less and less in the county.
Right.
Property values have gone down. When property values goes down, service provision of services, schools, infrastructure, all of that goes down, which means now you're in this debt spiral. And none of this you would have known if you hadn't done actual research to understand that the cab was trying to move to a California light model. Because it's like their old saying goes, right? Things happen very slowly and then all of a sudden. So understanding some market risks and dynamics with your demographics, with your politics, that's very important. And by the way, there's no right or wrong answer. You just have to be aware and do this level of research before you put your money into the deal.
Well,
Then,
you're poking at wounds for me because from an operational standpoint, DeKalb County and Langley Place, my next section is going into the personal side of things, but just to give everybody a taste of what that looked like, that was 18 months of working with the county to try to get one eviction. So we had about 10 people on our age receivables, our delinquency list. It took 18 months before one of those people was evicted.
exactly right. Now, the next couple of items I'm going to talk about are specific items. One is key person risk, and one is chasing returns. In fact, let me start by chasing returns first. Now, as much as this is about picking the right sponsor, the right investment for your hard earned money, you also have to realize a lot of sponsors are incentivized to show high returns on paper. Now, whether they do it intentionally, is there any malfeasance involved? I'm not really going to comment there. But here's the deal. During the last run up, I had many investors tell me, seemingly intelligent investors tell me, hey, look, I like you. I like your deal. But here's a new guy that I saw, and he says he can get 30% IRR, 40% IRR. And you are saying like 15 or 16% IRR, I think, is for those acquisitions. And when they started chasing returns, things that are too good to be true, the invariable thing happened. Guys, real estate is not like technology stocks, right? It's not like today you have a technology, it's great, and tomorrow you'll become a billionaire. It's not like 100x returns. But downside can also be managed to a certain degree in real estate. So you have a tight range of returns. And these home runs and all of this stuff, oftentimes you only find that out in hindsight. So if investors start chasing returns, you have to realize bad things are going to start happening to good people. If something is too good to be true, it probably is. You have to work with people that are conservative, that have defensible underwriting. They are staying in the game versus swinging for the fences. And oftentimes, not oftentimes, in fact, all of the times, return off capital is as important as return on capital. Okay. So chasing returns. Don't chase returns. Don't chase shiny objects. Always try to go for down the fairway, vanilla, conservative deals with conservative people. Now, key person risk is also very important. Key person risk basically means that it's a one man show or one woman show. And if this person leaves, is incapacitated, dies, the bus hits them or something, the whole edifice collapses. And I've seen this time and yet again, not just in real estate, but in a lot of investment endeavors. Always strive to work with teams. Look, within the context of our team at Boardwalk Well, yeah, you're seeing my beautiful face here along with Miles, right? And I'm the
Yeah.
founder of the I'm the founder of the firm, but we have intentionally built out a team where people have a lot of agency. Miles runs operations. Miles knows this goal. Miles also understands a lot of elements about our investor relations and marketing. Does he have to be an expert in those lines of work? No. But he has to have a good understanding. Our controller, Marilyn, as an example, she understands not just accounting inside out, we also have it on our operations call. Is this is this normal? Yeah, in bigger firms it is. Because your controllers, your accountants need to understand not just what's happened in the past, but what can be coming forward. Do they have to be operational experts? No, but they need to have context. Similarly, our director of operation, marketing, Kristen, right? Kristen is not just involved in the actual asset management and operations, but she's also involved in research and forward looking analysis. The reason why that is very important is that different people in the firm need to be cross trained. So, in the off chance one person leaves, is incapacitated, or dies, the whole edifice during investment is not at risk. Key person risk is a huge problem. If you do not focus on this stuff, these things can lead to bad outcomes. And look, lastly, a lot of the stuff otherwise is what people will tell you all the time. A lot of these things are balancing acts. You have to balance a good with a bad. If somebody tells you it's going to be a 3 year deal, fully expect it's going to be 5 years. Now, if you get your money back earlier, that's great. But look, you're also getting benefits along the way. You're getting tax write offs, you're getting cash flow, you're getting the upside of appreciation. So it's not all doom and gloom. But always try to understand in terms of frameworks as opposed to an exact specific answer that's like landing a spaceship on Mars.
Perfect. So, Omar, I don't want to deviate from everything you just said, but if this is to all our attendees today, if you do find that deal with returns that look too good to be true and they are real, just give me a call because we're always open to deals that have these true returns that are better than what reality can provide. Anyways, so that
Yeah,
was the
yeah, yeah.
landscape.
No, no, hold on, guys. We are not just in the business of making money for you. We're also in the business of making money for ourselves. So, in full disclosure, if
Yes.
you find something that's too good to be true that actually is true, as an example, we would also like to know because we also want
That's right. That's right.
yeah,
You know our number, please call us.
yeah.
Please. We're fine with that. Anyway, so that was the landscape, or in other words, the things that can go wrong. Now I want to go a little bit more personal. I want to share some of our own battle scars, so to speak, because I think the best way to earn your trust isn't to pretend we've never had a tough day. It's to show you how we responded when we did. So, the first battle scar I want to share with you is the item of new supply absorption. I'm sure you've heard lots about absorption and deliveries into a market. So, we had a deal where new supply in the submarket absorbed much slower than our original projections and frankly everybody's original projections. Units were coming in online all around us and the lease up timelines we modeled really just didn't hold up. Now, the instinct in that situation really is to start throwing concessions at the problem. Trust me when I say that that was the flavor of the day. There were many of our competition that were doing that very thing. 1 month free, 2 months free, 3 months free. Some of you investors have had conversations with me about this. Waive fees, whatever it takes to get bodies in bed. But here's the problem with that: concessions can be a race to the bottom. You
Yeah.
start giving away a month free, your competitor gives away 2 months. And now you've really trained the whole market, especially in some of these smaller markets, to expect a discount. So what we did instead was implement, to Omar's point, a more balanced approach. It's not to say that nothing is black or white. We made sure our units were turns were tight, fast, clean, market ready, so that when prospects came up, they were comparing us. Pardon me, they weren't comparing us to the brand new build down the street on price alone. They were comparing on value, and we leaned into what we could control: the resident experience, the curb appeal, the responsiveness of our management team. Ultimately, this looked like a small amount of concessions and rent reductions, in all honesty, but didn't destroy our rent roll doing so. So again, a balanced approach. The second scar that I want to share with you is the interest rate shock. So this one clearly hit a lot of sponsors, and I'm sure many of you on this call felt the ripple effects. When rates rose as fast as they did, it changed the math on virtually every deal in the market. And for us, one example was the impact felt at Pines of Lanier, one of our properties in Gainesville, Georgia. We made the decision on that property to pause distributions. Of course, that's understandably not a fun phone call for all involved. Nobody invests in a deal to hear that we're pausing your cash flow. But here's what we want to share: a distribution paused is a legitimate risk mitigation tool, a difficult decision to protect the asset and, by extension, your equity. Um, and the alternative was to keep paying out while the debt service was squeezing us. And that is how deals blow up. And I've definitely heard of that very thing: is keep the
Multiple
distributions.
people.
Yeah, yeah. Maybe Omar, you can speak to that more than I can, but I've definitely heard rumors of that, where distributions keep on going when there's no fathomable way for that to exist, right? Clearly, and it ends up blowing up the deal. So, anyways, we held firm. There was no favorable sales to pursue at the time. The market just wasn't there. But we eventually got the property refinanced with a big time lender, and I think we were only one of two.
Listen, no, hold on. Just to say, this wasn't a big time lender. We had a cash out agency refinance.
Yeah.
In all of Arbor's book from 2022, we were one of only two. I mean, we did the cash out refi 2025. We were only two people, I think, that had a cash out agency refinance. Not only did we start redistributing, we have fully caught up investors as of this quarter. So the point is that temporarily you have to make the right decisions as a steward of capital, but only if you're headed in the right direction with the right team. In the case of Pines and Lanier, we paused for a little while. We did cash out refinances and we started redistributing. And now investors are getting even more money than they anticipated. But again, the fact of the matter is, as Miles mentioned, we've heard many investors from many investors and sponsors that I know that what they didn't do was they didn't accurately forecast into the future. They did not basically have these forecasting abilities internally. They did not cross train people. So they kept distributing even in the face of real adversity. And then what happens is what typically happens in a lot of these transactions. Their assets were doing fine. I mean, they could be a little up or down. They ran into a liquidity squeeze, which meant that they had no cash left. And by the time they realized they had no cash left, it was all too late. So you have to understand distribution pauses happen. We've done that. But what are the steps after that and how do you recover from there on out? Because if you just stop there, or if you keep distributing because you don't want to have a painful conversation with investors, that can become a very bad situation very, very, very quickly.
Yep, absolutely. So that pain point or that battle scar clearly shows the risk of pause distributions, but the investors who thankfully stuck with us through that came out on the other side in a much stronger position, to Omar's point. Battle scar number three: using tax benefits as a shield. So this one is less of a scar and more of a strategy that came out of navigating tough markets. We've learned to use tax benefits, again, not just as a sales point, but as an actual risk mitigation layer. So let me give you a concrete example to that. When we structure deals with cost seg studies and accelerated depreciation, we're putting real dollars back in our investors' pockets through tax savings, sometimes in year one. That means even if the cash on cash return in a given year is lower than projected, again, a risk, the investor's effective return, when you factor in the tax benefit, can still be very competitive. So it's a way of de risking your original investment as investors, as LPs, by giving you multiple ways to win, not just one. So again, real risks coupled with risk mitigation factors. And to
And
wrap,
sorry, I just want to add a point there, guys. At the end of the day, the obvious disclaimer exists. You should not let the tax tail wag the investment dog. If the investment does not stand on its own 2 feet, if the investment is not a viable investment, do not do the investment. This is the sizzle on the top, but it's not the steak. So please keep that in mind because a lot of times depreciation is sold as this magic elixir that fixes all problems. It doesn't, because the obvious example, it's kind of facetious that I give is, hey, if you want to have 100% write off, why don't you give me all of your money? And I'll say that you lost it. That's pretty easy. I'll be happy and you'll be happy. You get 100% tax write off, I get all of your money. Obviously, you don't want to do that. So have investments that work on them by themselves. The tax component in savings is a very important component, but it only works if the investment works by itself. And at the end of the day, these are all deferral mechanisms. There's no avoidance here. You are merely kicking the can down the road. So understand that the longer you kick the can down the road, obviously a dollar today is worth more than a dollar tomorrow. So you have to plan for these things. It's not like a magic elixir where you have it and suddenly there is no, there is no con associated with it.
yeah, good point.
Mhm.
Appreciate that. So the last battle scar and highlights another risk is we've held longer than projected. So that's not at all the sexy answer. Nobody gets on a webinar excited to say, "Hey, we didn't sell when we said we would." But the reality is selling into, and this goes without saying, selling into a bad market just to hit a projected timeline is honestly one of the worst things a sponsor can do. You lock in losses, you give away upside, and you really hurt your investors to keep a PowerPoint slide accurate, for lack of a better term. So we'd rather hold an asset, let the market recover. Right now is a good example of that. Let the value materialize and exit when it makes financial sense, not when a calendar says so. And the feedback we've gotten from our investors on that approach has usually been positive because they understand we're managing for outcomes and not for optics. All right. So those are some real examples from our portfolio. Omar, can you please take us through the principles we use to manage risk going forward, the framework behind the decisions I just described?
Yeah, again, this is not an exhaustive list because this framework, you have to view these as frameworks. These things keep evolving and changing. So number one, capital preservation is greater than cash flow. I know everybody talks about cash flow. It's like this great thing that's going to save us. But at the end of the day, return off capital is as important, if not more important, as return on your capital. Think about it this way. You give somebody $100,000, they are the greatest real estate investor on the planet. Right now, they're maybe making 6 to 8%. Okay. Let's say six, 7,000. I'm going to call the middle of the road, right? You keep getting cash flows for 10 years. Those cash flows are $70,000, 7 times 10 for those that are weak at math, right? $70,000. But if at the end of this exercise, you never got your principal back, you're still out $30,000. So your capital has to be preserved. The return off your capital is as important as a return on your capital. And by the way, oftentimes you can't have it every which way. You can't say, I want to return off my capital, but I also want super high cash flow because we have seen this now. I mean, just in the last 4 or 5 years, or whatever. We've seen all these Bitcoin funds that are blowing up. We know a couple of guys that unfortunately are ensnared in that. They're the victims of this. I've had this ATM fund being pitched to every single capital raiser syndicator on the planet was pitching this ATM fund. 20% cash on cash. And this is at a time when interest rates were close to zero. That is a couple of $100 million Ponzi scheme. You can't, guys, you have to understand more often than not. things don't, you can't just have both things. I would also like to be a cool guy that's 7 foot tall, super athletic, playing professional sports. But that didn't really happen. So here I am. Right. So you have to have capital preservation, but you can't have sky high cash flow. Usually these things don't marry together. You can't have everything in life. That's just the way things are. Then you need to also be focused. Once I said, if the transaction works, as high income earners, you don't just have to be looking at gross returns, you have to be looking at net returns. This is where the tax component becomes really important. Think about it this way. If you're a high income earner, no matter where you live, you're possibly in the top two tax brackets for most people, right? This means your marginal tax is about 37% federal, because even if you live in Texas, no state income tax, you still have to pay the federal tax. That is 37%. No legitimate investment that I know of is going to return 37% year in and year out. I don't even think drug dealers make this kind of margin, right? So once the transaction, you have underwritten it, you feel comfortable with the team, all of the things check out, then you get into tax optimization. The reason why that's important is because most of our investors, they're high income earners. Their problem is in making the money. Their problem is all the leakages that happen along the way. So then you have to start focusing on tax efficient investing, because again, what got you to this level, right? The hard work, putting your money into 401k, all of that stuff. Well, now you're at a very different income bracket. So that's the same thing that got you here aren't going to take you to the next level. So tax efficiency becomes really important. Then you have to be honest with yourself and realize trees don't grow to the sky forever. In fact, we've written this down. There is nothing recession proof. Guys, so many times in the last 10 years, I have heard so many people say, pick whatever investment they're trying to sell you. This is a recession proof investment. Then they went to itself because the proof part didn't really work out. So then they went to recession resistant investment. Okay. The point is, there is no strategy known to mankind that works under every single environment. Okay. And as much as I would like to sit here and tell you, hey, please give me all of your money. Real estate is the greatest thing since sliced bread. No, you should be diversified. There is an element of you putting your money into the stock market, maybe buy a broad based ETF. There is an element of you investing in illiquid investments. There is an element of you investing in tax advantage investments. But you can't just go out on the spectrum and do 100 or nothing. Risk management is is oftentimes not putting yourself in a situation where untoward events can or maybe happen. Oftentimes, it's just avoiding these situations altogether. So start viewing it from a diversification angle. And lastly, guys, you have to remember, it's that old saying, you play long term games with long term type people. If somebody's trying to take shortcuts all the time, they're trying to cut corners. They've got this cute little strategy that only works if everything works out profitably. And let's assume you believe in that magic elixir. Don't do it. If you play short term games, you are going to have short term bad effects that will then lead to long term bad effects. Mhm. Look at the long term. Work with conservative, down the fairway people. It's not sexy, but boring beats sexy all the time in the investment industry.
Perfect. Thanks,
Right.
Omar. Great
Thanks so
stuff.
much. Great
All
stuff.
right, everyone. Before we open it up to questions, I want to leave you with one thought. Thomas Aquinas once said, if the highest aim of a captain were to preserve his ship, he would keep it in port forever. And I think
Oh, that's
that,
a good.
yeah, I like that, right? I know. I think that captures the tension of what we've really been talking about today perfectly. Risk is real. We just spent the better part of half an hour telling you everything that can go wrong. But the flip side is also real. If you have zero risk tolerance, you get zero reward. Your capital sits in a savings account earning less than inflation, and you're actually losing purchasing power while feeling safe. The goal isn't to completely avoid risk. The goal is to understand it, to price it, and to again partner with people who know how to manage it. And again, to Omar's point, that's where diversification comes in, and understanding risk and evaluating all the sum of all the sum of the parts, right? So with that said, let's open it up to questions. We've got a few that came in ahead of time, so we'll start there and then we'll take live ones. Omar, first question that's come up, can I sell my share in a multifamily syndication?
There is no secondary market. These are illiquid investments. So the short answer is no. These are illiquid by design. There is no public exchange where you can go sell these. This is why, by the way, there's also attendant benefits with this, right? The tax write-offs and all of this sort of stuff. You don't really get that if you buy an Apple stock or ExxonMobil stock. That being said, uh, transfers can happen with GP consent. So, for instance, you say, "Hey, I did a $200,000 investment. I want to sell it to my brother for whatever price you and your brother or brother-in-law or your friend have agreed to." Sure, that's just called a transfer, but typically that is unusual and you should not bank on it. Don't invest your capital, especially in these types of investments, if you have a very short-term specific timeline. Like, for instance, in 2 years, I want to pay for my kids' college education with this funds. Not the best use of that type of money.
Yeah. Yeah, that's right. If there's a chance you'll need that money in the near term, this probably is not the right vehicle for your capital.
Yeah.
Wonderful. I have a couple more just so everybody's aware. You can send in those questions and we will do our best to answer all of them. Omar, what's the point of a projection if you say to 3 to 5 years, but it ends up being longer?
Well, first of all, the projections you have to understand, guys, all performance, all projections, hopefully, when you're working with the right people, these are best faith estimates. These are built on assumptions. They're not a promise. Because again, if somebody could accurately project to the second decimal point 5 years into the future, they probably don't need your $100,000. They are, I mean, they're much smarter than I am, number one. and, I, and that doesn't just happen. Projections are best faith estimates with reality based assumption, or at least that's how it should be. Now, you also have to understand if you force a sale to hit a timeline, it could also lead to very adverse effects. As an example, you can lock in losses when maybe if you waited a little bit longer, you might not have had to pop invoices. So just for the record, though, we had exited investments earlier when we had a price that was too good to be true.
Mm.
So it's not like you should never try to exit investment. I mean, we joke internally, but it's kind of true. It's not really a joke. If some guy, drunk guy, shows up with a bag of cash, everything's for sale, including the sofa in my house, and the house behind Miles. Everything is for sale. You give us a good price, you can take it, no problem at all. But you also have to understand longer term investments from a sponsor point of view, like these longer term holds, typically are worse for sponsors. Selfishly speaking, I do not want to keep investments longer because here's the thing nobody talks about. The IRR clock is brutal. The reason why it's brutal is because if something goes from, say, 3 years to 7 years, well, first you got to pay back the lender. Then you got to pay back the investors. And then you have to pay back their principal capital. Then you have to hit their IRR threshold. And then if there's any money left, that'll come to the sponsorship team. So longer holds are actually worse off for sponsors purely from a financial point of view. So, but good sponsors realize it's a long-term game. So return off capital is, like I said, is as important as return on capital. So there is a balancing act there, but forcing sales early or I just don't think is always the right answer.
Right, right.
Right.
I liken it a little bit to like GPS, right? When I want to get to, let's say, Omar's house and GPS tells me X amount of time and I head that way and there's an accident or something and that timeline changes, it's really up to, I mean, you would hope that the GPS is gonna reroute you and give you a better option given the circumstances, and so that's a little bit how I think about this as well. You want your sponsor to be able to pivot, and Omar, I think you can speak to that. Given your time in this industry, you have to pivot at times despite what projections you made, because if you hold to those projections, you're either providing worser outcomes for those involved and or you're not reading the market and potentially skirting around something that's going on based in reality, correct?
Yeah, I agree with you. Again, as I mean, frameworks are important, and you have to understand that conditions, everything is contextual. But you need to have some base level of assumptions through which everybody can look at the future and say, okay, here's where we think things are going to be. At the end of the day, these are investments. These are not guaranteed. You have to realize this. Everybody realizes this. Investments carry an inherent level of risk. But that's why there is so much upside as well.
Perfect. All right. We have another question come in. Is real estate really an inflation hedge, or is that just an oversimplification?
I think it's directionally true. There are major caveats to this. Number one, there are certain lags. So think about leases you signed. In multifamily, typical leases are 10, 12 months. But if you're in commercial real estate, if somebody signed a lease, say, I don't know, 4 years ago, and they've got 6 years left on their lease, and market rates have gone up, as an example. So this is an under market rent. Well, then there's going to be a lagging effect there, right? It's not like a perfect inflation hedge because inflation might be going up, but you just have no way to capture that inflation through your rents. So, to a certain degree, it's an inflation hedge. It's not 100%. Uh, Specifically, the other way, if you look at it, is let's assume inflation is up, and as a result of inflation going up, the Fed rightly decides to uh, tamper demand and raises interest rates. Now, in that example, usually rates go up, values go down. It's an interest rate sensitive environment. Well, you might have signed a lease 3 years ago. Now that is worth way more value now because the market rent is way lower. And that guy or girl has to pay another 6 years of that rent. So my point is, it goes both ways. Directionally, it is correct. It is one of the better hedges, but it's not automatic protection as a lot of people make it sound it out to be. I think that thing about inflation hedge is like a textbook example. Literally, it's used in a textbook, right? To again provide a framework, to provide guidance, but it's not like the gospel.
Mhm. Perfect. This is a really good one. Can you run us through the red flags to look for when vetting a new offering? I think this is very practical and it
Oh
is
my
very
God, how
helpful.
long do you guys have? How long do you guys have? It's been forever. We only have like 20 more minutes. Okay.
Red
So
flags and green flags. We want both, please. Go.
oh no, well, green flags are not a lot, but red flags are a lot. So look, first of all, I would think that floating rate debt with no rate cap or expiring rate cap, so you're not hedging yourself, and also your it's on the wrong type of asset because again, floating rate debt in isolation with a rate cap, no problem at all. Okay, if it is with the right type of asset. But let's assume you've got a fixed, stabilized asset. You put short-term floating rate debt, no cap. You haven't hedged your risk. That is a big red flag to me. Then, for instance, there's a loan maturity, say, versus a business plan mismatch, right? So this is in the sense that the loan's maturing in 3 years, your business plan calls for a 5-year holding period. That's kind of a mismatch because what do you do at the 2.5, 3 year mark? The short answer, a lot of guys would give, well, we'll refinance. Well, that's great. Do you exactly know what's going to happen in 3 years? Because I don't. Nobody else does. Maybe this person does. So there's a mismatch. That's I would say that's calling out for something. The other thing that I would think about over here is what's the sponsor's track record, and not track record. Also, you have to realize a lot of track records are fake or not useful because they were done in a time when the market was only going up. So, what has been your track record lately as well? How many foreclosures have you had? What's capital calls that you have? What is your realized returns versus projection? Ask for real numbers. I think some other stuff that you could really look forward is also the sponsor's balance sheet. Now, this is going to be hard for you to figure out. Nobody's going to give you their own balance sheet. Okay. So you just have to make inferences based on the size of the sponsor and everything. But the sponsor's sophistication in terms of managing their loans and balance sheet, the liquidity they have on hand, because oftentimes, guys, you can be in a bad position, but if you have enough liquidity, you can ride out the storm versus people who don't have good liquidity and can't ride out the storm. And we've acquired assets from some people. And I think an indirect way to look at this is just to, again, it's not a perfect thing, but these are proxies through which you should be looking at, is to see as an example, look, what type of lifestyle does this guy lead, this guy or girl lead? Now, I see a lot of real estate people posting pictures of their cars and like they're taking a JSX and they call it their private jet. It's not, right? It's stuff like this. If somebody's too flashy, uh, I kind of try to stay away from that person just because I think flashy people make flashy endings. And again, real estate is very a by the book sort of business. It's not like it's not like technology or healthcare, right? Where you can become a billionaire overnight. So really managing your sophistication on how you manage your loans. Also, if somebody's really flashy, I'd kind of stay away from them. And lastly, look, If the sponsor can't answer simple questions like, hey, how does the debt structure work? Why do they have the debt structure? Why this asset? What's the business plan around it? Yeah, I would say that those would be some of the big red flags that would just uh, pop out at me.
Is flashiness gonna stay a red flag when you go through your midlife and you start, wearing blazers in, like, orange and fire red?
I have already told you, if I ever start doing that, you guys have full authority to come and punch me in the face. Yeah.
That's it for questions, Omar. Did you wanna say any parting remarks and let everybody go on their way?
No big parting remarks, guys. The point over here for doing these things is to make you more informed. And you realize a lot of the stuff that we mentioned over here, that I mentioned, that Miles has mentioned, this doesn't require a finance degree. It doesn't require you to have your CFA or your MBA, or you need to be a modeling expert. It requires you to understand and look at things holistically, take a step back, have a big picture view of items. And remember, it's always better, that old saying, to measure twice and cut once. It's the same as with investing as well. It is always better to get references, to double and triple check your assumptions, than it is to just look at somebody, see they have like, I don't know, 30% IRR, be wowed by it, and then only find out, I don't know, 3, 4, 5 years later that the paper that the return is printed on is not, it's not even the worth the paper that it's printed on.
Yeah,
So
yeah.
a lot of this is just following the middle path, not taking extreme risks, but realizing investing in it of itself is risky. So you have to take calculated risks along the way.
Perfect. Well, thank you, everybody. We are so thankful that you joined us today. We'll try to continue this trend of our monthly webinars. And if any future topics that you want to see come up, just let me know. And any questions that weren't asked today, also reach out to me and or Omar. But my email is miles@boardwalkwealth.com. Happy to chat more by email or over a call. And I hope you all have a wonderful Wednesday afternoon. Thanks, Omar.
But
Bye.